Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. I'm very excited for this episode. For a long time now, we've thought that people perhaps didn't appreciate the beauty and elegance of the index fund.
Yes, you've been harping on about it.
It's not the first time I said that.
No.
I know. We wrote a book on it
Yes.
maybe a year ago, and we still don't think they're quite appreciated enough. And luckily, our friends at iShares by Blackrock agree, and they've agreed to come and jump on the podcast with us and help us explore just how elegant and powerful an index fund can be.
That's it. So welcome to our 4-part series on the power of index ETFs. This series focuses on why, despite their growing popularity, we still think index ETFs are underappreciated and are a beautiful way for us to grow wealth over the long term. I'm actually going to be counting how many times you say elegant and beautiful across this series.
I think you just said it there.
Well, you said it in the intro. This series is an education collaboration between iShares by Blackrock, S&P Dow Jones Indices, and NAB Trade. If you're looking to invest in iShares ETFs but not sure where to get started, visit blackrock.com.au/iShares for information about their ETF range, or visit nabtrade.com.au to explore further insights, education, and tips for getting started with ETFs. Let's rip in, Ren.
Let's do it.
So today we are joined by an expert from iShares by Blackrock, Tamara Haben-Bierstatz, Director, ETF and Index Investment Specialists. Tam, welcome.
Thank you, Bryce. It's very exciting to be here with both you and Ren.
Nice. Tam, do you agree that the index fund is underappreciated and elegant?
Yeah, I just love those descriptors, elegant, beautiful, powerful. I mean, I think, definitely got some takeaways to bring back to my own marketing team. That's an excellent way to describe them because I couldn't agree more.
Now, over the course of these 4 episodes, we're going to talk about, different aspects of investing, things that investors want to do or want to achieve with their investing. And we're going to talk about how the index fund is set up to help us achieve them. So we're going to start in today's episode. We're going to talk about growth. We're all looking for growth with our investments. But then over the course of this series, we're going to talk about income and dividends. We're going to talk about cutting your losses. And then finally, we're going to talk about how index investing can be truly timeless investing. But Tam, we're going to start with what I guess most investors want in their portfolio, and that's growth. We're going to talk about the fastest growing companies in Australia and the US, why with indexes you don't miss out on them, the historic performance of indexes, and what that can add up to over a lifetime.
Very exciting.
A lot to cover.
A lot to cover. So let's cover off or have a look at some of the fastest growing companies in the ASX 200 over the past 12 months, because there is massive growth in stock market indexes. To rattle off a few that we've been talking about here, Ren, Clarity Pharmaceuticals.
Yeah, up almost 600%.
Absolute ripper. Zip.
Up just over 300% in the
Wow.
past 12 months.
Life 360.
Yeah, more than doubled.
Pro Medicus.
Almost doubled.
And Goodman Group.
Yeah, Goodman Group, one of the 10 biggest companies in the ASX at the moment, and it has gone up about 76% in the past 12 months. So there's been some incredible growth stories. Some of those names are more familiar. Zip. Is it back? Aussie investors have loved Zip, and now it's back. Well, they loved it, and then they fell out of love with it.
Yeah.
Now it's back in the ASX 200.
Yeah.
Goodman Group is really riding the infrastructure story around AI and data centers. So there's some really interesting and quite well-known stories there. But it's not just in Australia. Over in the US, we've seen some incredible growth over the past 12 months as well in the S&P 500.
We have. So in the S&P 500, super microcomputer absolutely buzzing AI hype again, up 157%. Carvana, up 181%. Vistra Corp, up 170%. Nvidia, despite being on an absolute tear for the past couple of years, has still pumped out 164%. And Constellation Energy Corporation, up 96%.
Yes. Now, if that just feels like a list of companies and a list of numbers, I think the point that we wanted to really start this series with is that there is massive growth in the major stock market indexes. I think where some investors start to trip themselves up is they start to think, if I want growth, I have to go smaller companies outside of the major indexes, and the indexes are full of big and boring companies. So let's start there. That is not true, is it, Tam?
No, I mean, I think that's the first. There are some mainstays that have been perennially in some of these indices that you've mentioned. But as you say, there's been phenomenal growth in particular individual stocks as well. And I think the beauty, right, beautiful,
Nice.
the beauty
That's three.
of the index fund is that the index actually does the work for you. So the rules-based approach that indices have in determining their methodology to make sure that your ETF, for example, is representative of the companies that are biggest. For example, the ASX 200 is representative of the 200 largest companies in Australia, listed on the ASX by market capitalisation, which is simply a function of price times by shares on issue, or indeed something like the S&P 500. All of these indices can be tracked by index funds, and what we've done, and others as well have done, is wrap up those companies into neat little packages called exchange-traded funds, so ETFs. And I guess to get back to your point on growth, we all want our portfolios to grow. That's the whole point of investing. We're investing for, whether it's a holiday or whether it's sensible investments for retirement, depending on your time horizon. We want our pool of money to grow, and I think the best way, or a sensible way to do that, is to really get what we would call the core of your portfolio, so the bones and the core of your portfolio, into companies that have grown and that have made it into those core indices.
Yeah, so I think that's a really important point to I guess articulate, because the design of these products, you mentioned their market capitalization, and so what we find is, as some of these companies that we've spoken about start small early on in their business cycle and continue to grow, and their stock price goes up, then their market capitalization increases, and you find that as they grow, they move further and further and further up the index. The nice part about the ETF index as well is that as some of the larger companies that aren't performing so well start to go down the business cycle, they start to move out of the index. And so you're capitalizing and getting access to a lot of these growth companies as they come through without having to lift a finger.
Exactly, and I think the representation of those companies as they get larger, or indeed smaller, is accurately adjusted at what we call a quarterly rebalance. So again, it's the power of the index methodology doing that work for you. So you have the exposure to the companies that have grown.
Yeah.
Or indeed, if their size, their market capitalization does indeed fall, the ETF will, of course, adjust their representation in that pool of assets.
Let's illustrate that point, because when we talk about the beauty and the elegance of the index product, I think
That's five.
I think the quarterly rebalance is a moment where that really comes through. You get more of the winners and less of the losers. And we've taken a look at the March 2024 rebalance for both the ASX 200 and the S&P 500, and looked at the companies that were added and the companies that were removed, because I think there is no clearer illustration of you get more of the growth companies and less of the companies that are shrinking.
Yeah. So let's have a look at the ASX 200. And I think, just to go back to basics here, the rebalance happens every quarter to major indices here in Australia and globally. So companies added to the ASX 200 in the March rebalance, we had Audinate, Red 5, SiteMinder, and Stanmore Resources. And then the companies that were removed, we had Chalice Mining, Core Lithium, Sayona Mining, and Weebit Nano. But the important thing here, Ren, is to actually look at the performance of these to illustrate the rebalance.
Yeah, so some familiar names and some not so familiar names. But the 4 companies that were added, so we've taken a look at their performance over the last 12 months to time of recording. Audinate up 75%, Red 5 up 29%, SiteMinder up 49%, and Stanmore Resources up 36%. So they're all up double digits. That is the story of the index. That's the story of growing companies being added to the index as they reach the top 200. The flip side is also true. The companies that were removed, Chalice Mining down 35%, Core Lithium down 86%, Sayona Mining down 78%, and Weebit Nano down 60%. Companies that are falling out of favor, that are getting smaller, are the ones that are being removed. So you get more of the winners and less of the losers. Great.
Great. Let's have a look at the rebalance over on the S&P 500 to see if the story plays out the same. So added, we had KKR, CrowdStrike, and GoDaddy.
Controversial company
Yes.
at the moment.
Yes, global outage. And then removed, we had Robert Half, Comerica, and Illumina. 3 companies I'd never heard of.
Well, I think that even before we talk about their performance, that in itself is an indication of the power of these indexes. Is like the companies that are being added are the companies that you recognize. CrowdStrike, maybe not for the best reasons, but even before what happened, they were sort of the gold standard in cybersecurity. But, you know, GoDaddy, KKR are more well known than some of these companies. But they're not added to the index because they're known. They're added because they're performing. KKR up 94%, CrowdStrike up 76%, even with their recent fall, I might add, and GoDaddy up 96%. And on the other side, Robert Half down 18%, Comerica down just 1%, but obviously couldn't keep up with the other companies in the index, and Illumina down 36%. So again, the story, it plays out. It might sound like we're repeating ourselves, but it's because we really want to emphasize this point that you're getting more of companies that are growing at meaningful rates.
Yeah, I mean, I guess one point that I would make, I think you've listed off several stocks, and I think one of the key points, one of the key ingredients for us anyway, for a growing portfolio is actually to remove that, what we would call idiosyncratic stock risk or single stock risk, because as you've just demonstrated, there can be some pretty enormous swings, positive and negative. Again, what the ETF does and the power of indexing does, the beauty, is sorry to sound a little bit repetitive, but it's a diversified portfolio. And I think as an ingredient for growth and a robustness within your core investment portfolio, it's probably to remove that idiosyncratic risk and have a well-diversified portfolio. And having access to companies that have, through a rules-based systematic process which the index provider has created and details, you are getting access to companies that have kind of met the requirements of being in the top 200 or the top 500 companies. So I just think that point around diversification as an ingredient for growth, I think is a really key one.
I think that's so important because, you know, we've just listed a whole bunch of individual companies and some people might be thinking, well, no, I don't need to invest in the index. What I should be doing is finding those individual companies and just investing in them. But that's...
Right. Great. Look, if I had the crystal ball, I'd do that as well, Ren. But I think the reality is no one's got the crystal ball.
And look, we're not just saying that about, you know, stock picking and active management. One of our partners in this content series, S&P Global, they actually keep a scorecard of how active managers go against the index, so we can look at the historical track record. Indeed,
yeah. The SPIVA report, I think, is the report you're referring to, Ren. Yeah, very well regarded, has been going for quite some time now. And I think what that particular report highlights and identifies is that active stock management is a very difficult thing to do. It's not impossible, but over history, for example, the last 5 years to the end of 2023, the index, the ASX 200 index, outperformed over 60% of Australian equity funds. For example.
In the second half of this episode, we're going to take a look at the historical performance of some of the ETFs and the challenges that we face as investors finding those gems. But before we do, a massive thank you goes to iShares by Blackrock, S&P Dow Jones Indices, and NabTrade for supporting this educational collaboration. If you're feeling overwhelmed with what to invest in or which companies to pick, then don't worry. We have all been there, Ren and I included, with iShares, S&P ETFs like IOZ, IVV and IOO. You can get low-cost access to hundreds of the world's largest companies in a single trade to help diversify your portfolio and help reduce the stress.
S&P Dow Jones Indices does not support, endorse, sell, or promote any product based on an S&P Dow Jones index, nor does it make any representation regarding the advisability of investing in the products. Before making any investment decisions, you should assess whether the product or service is appropriate for you and read the PDS and TMD available at blackrock.com.au.
So, Tam, I guess a question around picking individual stocks and how to use these core indexes. How are you seeing investors use core index funds in this sort of core v satellite?
Right. So I think one of the first things we touched on was kind of setting up a portfolio for capital growth. And I think these core index funds, which you've mentioned, so for example, the S&P ASX 200 Core ETF, which is IOZ, and the S&P 500 ETF, Core ETF, which is IVV. I mean, these, again, by definition, are giving you access to a diversified pool of assets that are large. They, again, make the cut for being in that index depending on the rules. And I think having the low cost kind of core of your portfolio with those two, and you know, there are other core funds available as well that can complement. But if we just take those two, for example, you're getting access to over 700 stocks, 11 different sectors in 2 trades. Remember, ETFs make it easy for people to invest instead of going and placing 700 individual trades, which doesn't feel very efficient.
No, the brokerage cost on that would hurt.
Exactly, brokerage.
Rebalancing.
You know, how would we even look at that on a page, right? It's difficult. And I think that access point, the ETF vehicle is an access point for, particularly for low-cost core, is a really good use case for ETFs. And I think they can be complemented by satellite exposures that might come at higher cost, or they might be more niche, tailored to your particular risk appetite. That's how we would generally see a core satellite approach, which is becoming very, I guess, you know, it's a popular tagline in investing, but it's popular for a reason.
The other thing when you think about a core and a satellite approach is even if you're building out a satellite, not with individual stocks, but perhaps with thematic ETFs or more, I guess, niche ETFs, you're still making a judgment call on where the growth is going to come from in the future and what industries or what sectors will do well, or if you're investing in individual companies, what companies will do well. But I think, and I'm going to say it again, the elegance of the index is you really capture that growth wherever it comes from, because you don't have to be a stock market historian to look back at the last 10 or 20 years and see the number of times experts and talking heads and everyone was surprised by where the next leg of growth came from in the market. Like, I don't think anyone would have 2 years ago said it's going to be, you know, super microcomputer and, you know, some of these like, and Goodman Group, some of these like AI adjacent names that are going to be like the big winners in these indexes. But AI came and then all these associated investments were made and they were the big winners. And whether or not you had a thesis on Goodman Group and whether or not you were interested in property development and property ownership, like if you own the index, you benefited from that. And I think that's the really important thing about having that core diversified exposure.
Absolutely. And, you know, again, having a core exposure doesn't mean that you are prohibited in any way from investing in other things. I liked the way you said you're capturing the growth from wherever it might come from. And you can't necessarily know that, particularly with something like we've seen in the AI boom at the moment. I think that's not just, our view is that it's not just a fad. That is something here to stay. It's actually one of our core, top of house views. We're very, I guess, positive, and we really like that as a growth theme. And you're actually getting access to that theme in IVV, for example. Tech, and particularly tech that's related to AI, makes up a large proportion of the IVV ETF at the moment. And I guess actually one point that, you know, since we're talking about IVV and I guess the S&P 500, I think one thing that's probably really important for Australian investors to remember is that you aren't necessarily able to get that in the Australian share market. So it is a core exposure. The S&P 500, US S&P 500, that is core, and you're getting different things than your potentially getting in the financial and materials heavy ASX 200 market. So again, going back to the principles of diversification at a really low cost or effective cost is we would argue something that makes for a good portfolio.
Yeah. Banking and mining.
Now, look, at this point in the episode, I think we've made the case that there are a lot of companies that are growing quite quickly in these indexes, be it the Global 100, the ASX 200, or the S&P 500. But that's not the most important question for investors. The most important question for investors isn't, are there some companies that are growing? It's, are the indexes themselves growing at a fast enough rate to help me achieve my financial goals, to help me build the wealth that I want to build, or whatever it is that I want to do with my investing. Now, Bryce, you've pulled the numbers here for all three of those indexes. So why don't you help us answer that question? How have these indexes been growing overall?
Well, Ren, Tam, let me tell you, the news is good. Here's how the returns have translated historically. So for the S&P 500, IVV, past 10 years annual average return of 16.24% per annum, which translates to 350% cumulative over the past 10 years. Now, tell me that is not growth.
That is growth.
ASX 200, IOZ, the story is similar. Past 10 years annual average, 7.6% return per annum, translating to a 108% cumulative return over the past 10 years.
Not as good as America, but you're competing against some big tech giants over
names,
there.
Big names. But let us, as we've said many times on this show before, there is nothing wrong with a 7.6% return over 10 years. Absolutely nothing wrong. You will certainly be in a good position if you just take that over 10 years. And then finally, the Global 100, the IOO, past 10 years annual average of 14.49% per annum, translating to 287% cumulative over the past 10 years. And I think for me, this really illustrates that sort of fear that a lot of people have, or misconception when they start investing, that ETFs are all about diversifying to reduce risk. But then with that, there's that fear of, I'm missing out on the growth. I need to go and pick these stocks to get that growth. The numbers are here. Taking that year on year, you're in a very good spot.
Yeah, the average annualized growth numbers are they're very robust. But I think the more important point is it's time in the market. Over 10 years. There are going to be ups and downs, of course. We saw that in 2022. But it's time in the market and staying invested, which I agree can be daunting, particularly for first-time investors.
Well, speaking of time in the market, we love a compound interest calculator here. And so we've put some of those return figures into the Money Smart compound interest calculator. So here's a scenario that we've calculated. If you invested $100 a fortnight for 30 years, that's $78,000 invested over that time period. At a 7.6% annual return, you walk away with just shy of $300,000. You've almost quadrupled the money that you invested. At a 16.24% return per year, so that was what the IVV was averaging, you've got $2 million, which is you're sorted for retirement and then some. So I think those are the kind of numbers that illustrate your point there, Tam, about like when you put those numbers over an investing lifetime, they start to really look meaningful.
Absolutely, and let's not forget these are the core index funds. So this is not necessarily going out on a limb, having a big punt on a particular stock that you really liked the sound of when you heard management talk about it. It's a different style of investing, and it's over the long term. It has historically worked very well.
And it's done without the stress of monitoring individual stocks. It's done without needing to spend hours researching. It's done stress-free, rebalancing, you name it.
Bryce, you're starting to. You almost might say they're elegant.
No way.
Well, look,
That is
we've got
reserved for you.
We've got 3 more episodes to convince you, to finally get you to say those words, how elegant these indexes are. And Tam, you'll be joining us in our next episode where we cover income and dividends, what you've historically been able to get from some of these indexes.
So we would like to say a massive thank you to iShares by Blackrock, NabTrade and S&P Dow Jones Indices for supporting this series. As Ren said, we've got 3 more episodes coming up. And if you're looking to invest in ETFs, but you're not sure where to get started, head to blackrock.com.au/iShares for information about the iShares ETF range available in Australia, or visit nabtrade.com.au to explore further insights, education, and tips for getting started with ETFs. We'll provide links to those in our show notes.
S&P Dow Jones Indices does not sponsor, endorse, sell or promote any product based on an S&P Dow Jones index, nor does it make any representation regarding the advisability of investing in the products. Before making any investment decisions, you should assess whether the product or service is appropriate for you and read the PDS and TMD available at blackrock.com.au.
Well, Tam, it's been an absolute pleasure. We will be back next episode digging into income and dividends. Looking forward to it.
Same here. Thank you for
Equity mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.